Welcome to Farmtips Diary. When interest rates spike, farms don't just feel pressure, they face existential threats that can erase generations of work in months. This is the story of how high rates reshaped farming economics across decades, what separated survivors from casualties, and how modern farmers can build financial resilience before the next rate shock arrives. When money became expensive, interest rates are more than numbers on loan documents. They're the invisible force that determines whether farms expand or contract, survive or collapse. Understanding this force means understanding agricultural history itself. In the 1970s, interest rates seemed reasonable. Farmers borrowed at 7 to 9% to buy land and equipment. With commodity prices rising and land values soaring, those rates felt manageable. The economics worked. Borrow at 8%, earn returns of 12 to 15% on assets, and the gap between cost and return creates wealth. Then, everything changed. By 1981, the prime rate exceeded 21%. Variable rate loans that farmers took out at 8% suddenly demanded payments at 18 or 20%. Monthly debt service more than doubled. A loan payment that was $3,000 became $7,000 without warning. The math became brutal. A farmer who borrowed $200,000 at 8% paid about $16,000 in annual interest. At 20%, that same loan demanded $40,000 yearly. For context, that's often more than the net income a mid-sized grain farm generated in a good year. The debt service alone consumed everything the farm earned and then some. This wasn't theoretical. It happened to hundreds of thousands of farmers simultaneously. Those who survived didn't do so by luck. They made specific choices before, during, and after the crisis that separated them from those who lost everything. Understanding those choices provides a roadmap for navigating future rate environments. High interest rates reshape farm economics in three fundamental ways. First, they increase the cost of carrying debt, turning manageable loans into crushing burdens. Second, they reduce asset values because buyers can't afford to pay as much when financing costs more. Third, they squeeze cash flow from both directions simultaneously, increasing expenses while decreasing the equity that backs credit lines. This triple squeeze is why rate spikes are so dangerous. It's not just one problem but a cascade of interconnected financial pressures that compound each other. Farmers who understood this dynamic prepared differently than those who assumed rates would stay low forever. What survivors did right? Walk through any agricultural region today and ask older farmers how they made it through the 1980s. Their answers reveal patterns that transcend individual circumstances. These weren't the farmers with the most land or highest yields. They were the ones who made smarter financial decisions. First, survivors maintained lower debt loads relative to asset values, while others leveraged up to 60 or 70% of equity. Survivors kept debt below 40% even during good times. This provided a cushion when land values fell. They could withstand 20 or 30% declines without going underwater on their loans. Second, they prioritized fixed-rate debt over variable-rate loans. This decision seemed expensive during the low-rate 1970s. Fixed rates cost 1 to 2%, more than variable rates, and farmers who chose variable rates initially paid less. But when rates spiked, fixed-rate borrowers were protected. Their payments stayed constant while others saw costs explode. Third, survivors aggressively paid down debt during good years instead of expanding. This seems counterintuitive. Good times feel like the right moment to grow, but survivors recognize that cycles turn. They used profitable years to reduce vulnerability rather than increase it. When crisis hit, they had less debt to service and more flexibility. Fourth, they maintained larger working capital reserves. Operating loans covered immediate needs, but survivors kept 6 to 12 months of expenses in accessible savings. This buffer allowed them to weather short-term income drops without immediately defaulting. Many farms failed not because they were fundamentally unprofitable, but because a single bad season exhausted their reserves. Fifth, they diversified income sources. Farms relying solely on corn or soybeans faced total exposure to commodity price collapses. Survivors raised multiple crops, maintained some livestock, and often had off-farm income from spouses working in town. This diversification meant that no single price decline destroyed their entire income. Sixth, they maintained strong relationships with lenders and communicated proactively. When problems emerged, survivors contacted banks immediately with plans to address issues. Lenders prefer working with transparent borrowers to protect loans rather than forcing foreclosure. Farmers who hid problems until crisis was unavoidable often found lenders had no choice but to foreclose. Seventh, they were willing to shrink temporarily to survive long-term. This meant selling equipment, renting out land, or taking outside jobs. Pride often prevented struggling farmers from downsizing until too late. Survivors recognized that temporarily scaling back preserved the core operation for eventual recovery. The fatal mistakes. Just as clear patterns emerge among survivors, common mistakes define those who lost farms. Understanding these errors is as important as knowing what worked because they reveal the psychological traps that ensnare rational people during boom times. The biggest mistake was borrowing based on inflated asset values rather than operating income. Farmers looked at land worth $3,000 per acre and borrowed $2,000 per acre, assuming the equity provided security. But when land values fell to $1,500 per acre, that $2,000 loan exceeded the collateral value. Lenders demanded additional collateral or payment, triggering cascading failures. The correct approach was borrowing based on what the land could produce, not what it was worth. If an acre generated $300 in annual net income, sustainable debt service was perhaps $100 to $150 yearly, supporting total debt of $1,200 to $1,500 per acre at 10% interest. This conservative calculation would have prevented over-leveraging, regardless of market values. Second, farmers assumed good times would continue. This normalcy bias is powerful. When grain prices stay high for 5 years, it feels permanent. When land values double, it seems like smart investing. But agriculture is cyclical. Assuming the current environment will last indefinitely guarantees being caught off guard when it inevitably changes. Third, farmers expanded during peaks and contracted during valleys. This is backwards. The time to expand is when land is cheap, equipment is affordable, and competition is reduced. The time to consolidate is when prices are high and everyone wants to buy. Contrarian timing is emotionally difficult but economically sound. Fourth, farmers ignored early warning signs. Before the 1980s crisis fully struck, indicators existed. Export growth was slowing, interest rates were rising, profit margins were tightening. Farmers who adjusted to these signals fared better than those who dismissed them as temporary fluctuations. Fifth, farmers treated operating loans as permanent capital. Operating loans should finance inputs for a single season, repaid at harvest. Instead, many farmers rolled operating debt year after year, using new loans to pay old ones. This created a growing balloon of short-term debt that eventually became unserviceable. Sixth, farmers maintained lifestyle spending even as profitability declined. New vehicles, vacations, and household expenses continued at boom-time levels. This prevented capital accumulation that could have buffered against downturns. Successful farmers adjusted personal spending to match farm profitability, maintaining reserves for inevitable tough years. Strategic debt management today. Modern farmers face similar interest rate risks, but with better tools for management. The question isn't whether rates will rise again, but when, and how prepared farms will be when it happens. Strategic debt management builds resilience before crisis arrives. Start with debt structure. Match loan terms to asset lifespans. Land purchases deserve 20 to 30-year mortgages with fixed rates. Equipment should carry 5 to 7-year loans matching useful life. Operating expenses need seasonal credit repaid at harvest. This matching ensures debt service aligns with the productive life of financed assets. Prioritize fixed-rate debt when rates are low. Even though fixed rates cost more initially, they provide certainty. If interest rates are below 6%, locking in long-term fixed rates is often wise. The premium paid for fixed rates is insurance against future spikes. When rates are already high, variable rates with caps might make sense, allowing benefit from eventual declines while limiting upside risk. Maintain debt-to-asset ratios below 40%. This provides cushion for asset value declines without going underwater. When ratios creep above 50%, alarm bells should sound above 60%. The farm is dangerously vulnerable to any adverse event. The difference between 40% and 60% debt ratios is often the difference between surviving and failing during stress. Build and protect working capital reserves. Target 6 to 12 months of operating expenses and accessible savings. This seems excessive during good years but proves invaluable during bad ones. These reserves allow riding out temporary price drops, weather disasters, or equipment failures without defaulting on obligations. Stress test financial plans against adverse scenarios. What happens if commodity prices drop 30%? If yields fall 20%? If interest rates double? Farmers who model these scenarios before they occur can adjust preemptively. Those who only react after problems emerge often find options already exhausted. Diversify revenue streams to reduce income volatility. This doesn't mean every farm needs 10 enterprises. It means not putting all risk in one basket. Crop farmers might add livestock. Livestock operations might direct market some production. Any farm can explore agritourism, custom work, or land rental. Multiple income sources, smooth cash flow, variability. Use risk management tools actively. Crop insurance protects against yield and revenue losses. Futures and options markets allow price risk hedging. Forward contracts lock in margins before planting. These tools cost money but reduce exposure to catastrophic outcomes. The farmers who survive crises are those who paid for insurance before they needed it. Refinance strategically when opportunities arise. When interest rates drop significantly below existing loan rates, refinancing can reduce debt service substantially. A 2% rate reduction on $500,000 of debt saves $10,000 annually. Over a loan's life, this compounds two significant savings that improve financial resilience. Modern tools and timeless principles. Today's farmers have financial tools their predecessors couldn't imagine. Yet the fundamental principles separating survivors from casualties remain unchanged. Understanding both the tools and principles creates robust strategies. Modern tools include sophisticated farm management software that tracks every expense and revenue source in real time. Farmers can monitor profitability by enterprise, field, or even individual activity. This granular visibility enables early problem detection. If corn production is losing money while soybeans profit, adjustments happen immediately rather than after realizing losses at year-end. Banking relationships expanded beyond local institutions. Farmers can compare loan terms from commercial banks, farm credit system lenders, and government programs. Competition improves terms and increases options. Online lending platforms emerging in agriculture provide additional alternatives, though caution is warranted with new models. Financial advisors specializing in agriculture provide objective perspectives. Accountants, financial planners, and farm business consultants offer analysis that individual farmers can't easily perform. The cost of professional advice is minor compared to the value of avoiding major financial mistakes. Tax planning tools allow strategic income timing and expense management, accelerating depreciation, timing grain sales, and structuring entities for tax efficiency can save thousands of dollars annually. These savings improve cash flow and build reserves. Yet beneath these modern tools, timeless principles remain paramount. Live below your means during good times. Save during booms to prepare for busts. Maintain conservative leverage. Diversify to reduce concentrated risk. Communicate proactively with lenders. Stay informed about economic conditions. Adjust quickly when circumstances change. The principle that most reliably separates survivors from casualties is simple: humility. Survivors recognize they can't control or predict markets, weather, or interest rates. They prepare for adversity even during prosperity. They make decisions that sacrifice maximum gains during booms to ensure survival during busts. Farmers who failed often exhibited overconfidence. They believed they could predict prices, that their management skills overcame financial imprudence, or that this time was different. This confidence led to excessive leverage, concentrated risk, and inadequate reserves. When reality contradicted their assumptions, they lacked the flexibility to adjust. Humility manifests practically. It means borrowing less than lenders offer. It means growing more slowly than possible. It means maintaining reserves that seem excessive. It means preparing for scenarios you hope never occur. This approach sacrifices short-term optimization for long-term resilience. Another timeless principle is that cash flow matters more than paper wealth. A farm worth millions is irrelevant if it can't generate enough cash to service debt and cover living expenses. Asset-rich, cash-poor operations are vulnerable. Prioritizing cash generation over asset accumulation often proves wiser, especially during high-interest rate environments when assets decline in value while debt service increases. Building resilience before crisis. The time to prepare for high interest rates is when rates are low. Waiting until crisis arrives leaves few options. Building resilience requires proactive decisions that sometimes feel unnecessary during good times. Start by auditing current debt structure. Document every loan's balance, interest rate, payment schedule, and whether rates are fixed or variable. Calculate total annual debt service. Compare this to average annual farm income over the past 5 years. If debt service exceeds 40% of gross income, vulnerability is high. Next, model interest rate scenarios. If variable rate loans doubled in cost, could the farm service debt? If not, refinancing to fixed rates or paying down debt should be priorities. The cost of fixing rates now is minor compared to the cost of unserviceable debt later. Then examine asset-to-debt ratios. Calculate current market value of all farm assets, including land, equipment, and inventory. Compare to total debt. If the ratio exceeds 40%, focus on debt reduction or asset growth through retained earnings rather than borrowing. Getting this ratio down provides cushion for inevitable downturns. Build working capital systematically. Set aside a percentage of net income annually toward reserves. Even 10 to 20% accumulates significantly over several years. These funds sit in accessible savings, not invested in illiquid assets. Their purpose is emergency buffer, not maximum return. Develop relationships with multiple lenders before needing them. Having established credit with several institutions provides options during stress. If one lender becomes restrictive, alternatives exist. Farmers with single lender relationships often find themselves trapped when that lender changes terms or refuses to extend credit. Finally, create a contingency plan. What specific steps would you take if interest rates doubled? If commodity prices collapsed? If yields fell by half? Writing these plans forces concrete thinking about options. Many farmers discover they lack good options, revealing the need to adjust current positions before crisis forces hasty, suboptimal decisions. Recap. High interest rates reshape farming economics by increasing debt service costs, reducing asset values, and squeezing cash flow simultaneously. This triple squeeze has destroyed thousands of farms across boom and bust cycles. Survivors shared common traits: lower debt loads, fixed-rate borrowing, aggressive debt reduction during good years, larger working capital reserves, diversified income, strong lender relationships, and willingness to temporarily shrink. Those who failed over-leveraged based on inflated assets, assumed good times would continue, expanded at peaks, ignored warning signs, and treated operating debt as permanent capital. Modern farmers have better tools, including management software, diverse lending options, financial advisors, and risk management instruments. Yet timeless principles remain paramount. Live below your means, save during booms, maintain conservative leverage, diversify risk, communicate proactively, and approach farming with humility. The smartest farmers aren't just growing crops, they're growing resilience by building strategic debt structures, maintaining reserves, stress testing plans, and preparing for adversity during prosperity, because when the next rate shock arrives, preparation determines survival. If these lessons on surviving high interest rates gave you valuable perspective, give this video a like and share it with anyone managing farm debt. Subscribe to Farmtips Diary for more practical strategies on building financially resilient farm operations. Hit that notification bell so you never miss insights that could protect your farm's future. Thanks for watching, and we'll see you in the next one.